Hello, everyone. Well, there was a bit of confusion yesterday with the U.S. ISM index, which got recalculated twice. Overall, the global manufacturing PMIs yesterday were not particularly encouraging. Two-thirds of the major countries showed a decline, and several countries, including France and South Korea, moved from expansion to contraction. This suggests that the recent upswing in the global manufacturing cycle may be drawing to a close. If the recovery in China turns out to be a false dawn, for example, if the slowdown in the Chinese real estate market swamps the government's efforts to boost growth, then I'd really start to worry about sentiment towards emerging markets in general, and in particular how emerging market carry trades might perform. The famous Fragile Five, Brazil, Turkey, South Africa, India, and Indonesia, would probably come to the fore once again, as a slowdown in global activity would make investors more selective and more cautious about selecting carry currencies simply on the basis of yield. This concern may explain why the dollar rose against almost all the EM currencies that we track, with 4 of the aforementioned 5 currencies doing particularly badly, the Indian rupee being the exception as investors awaited this morning's RBI rate decision. With the U.S. ISM index rising to one of the highest PMIs in the world, sentiment towards the U.S. economy improved yesterday, and the implied interest rate on the long-dated Fed funds futures rose. That's one reason for the recent strength of the dollar, especially in light of questions about other countries' commitments to tightening policy. This divergence in monetary policy is one reason why I'm expecting the dollar and the pound to rally broadly over the next several months. The RBA held its monetary policy meeting overnight and left rates unchanged, as everybody expected. They once again said that they expected, quote, a period of stability in interest rates. The tone of the statement was somewhat more optimistic about the domestic economy, which may be why the Australian dollar recovered somewhat following the announcement. On the other hand, the RBA repeated its comment about the exchange rate being high by historical standards and added, particularly given the further decline in commodity prices. Now, I agree on this point. The decline in commodity prices and the concomitant decline in the country's terms of trade implied by the slowdown of the Chinese economy is one of the major reasons why I expect the Australian dollar to weaken going forward. During the European day today, the main event will be the Eurozone's preliminary CPI for May. It's forecast to have slowed. Normally that would be very important, but yesterday's German CPI was also below expectations, but had only a fleeting impact on the euro. That suggests the ECB's response to lower inflation is already factored into the euro's price, so I don't expect much of a reaction to the Eurozone CPI data today. U.S. factory orders are forecast to have risen 0.5% month-on-month in April, a slowdown from a revised 0.9% rise in March. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.